are cooked!
In 1997, WorldCom was worth $3 billion. By 2002, it was bankrupt. 5 years, from the largest telecommunications company in the world, to complete and total collapse. And the fraud that caused it was hidden in plain sight. In spreadsheets, in accounting entries, in a culture where hitting numbers mattered more than telling the truth. This is the story of WorldCom, and the biggest accounting fraud in American history. WorldCom started small. In 1983, a man named Bernie Ebbers founded Long Distance Discount Services. It was a tiny long-distance telephone company, operating out of Mississippi, a backwater state with no telecommunications industry, no infrastructure, no talent, no reason to exist. But Ebbers had an idea. He would buy up struggling telecommunications companies, consolidate them, cut costs ruthlessly, eliminate redundancy, and turn them into profit machines. It was a simple formula, and it worked. By the 1990s, WorldCom had grown through dozens of acquisitions, swallowing up competitors left and right. By 1997, WorldCom was worth $3 billion. By 2000, it was worth $115 billion. Bernie Ebbers had turned a tiny Mississippi company into a global telecommunications giant. And he had made himself a billionaire in the process. But there was a problem. The growth could not continue forever. Acquisitions slowed down. The telecom industry matured. Competition became fierce. And WorldCom's revenue growth started to flatline. For years, Ebbers had built his entire reputation on one thing: consistent quarter-over-quarter growth. Every single quarter, the numbers went up. Wall Street loved it. Investors loved it. Analysts loved it. But now the growth was stopping, and Ebbers faced a choice: accept the reality that growth had slowed, tell investors the truth, watch the stock price fall, watch his fortune evaporate, or find another way, a way to keep the numbers going up, even if the numbers were not real. Ebbers chose the second option, and he brought in a man named Scott Sullivan to make it happen. Sullivan was the CFO of WorldCom, a number cruncher, a details man, someone who understood accounting, and someone who understood how to manipulate it. Starting in 1999, Sullivan began a scheme that would reshape the company's financial statements. He instructed accountants to move expenses into capital accounts. Capital expenses are investments in equipment and infrastructure. They are amortized over years. Operating expenses are the cost of running the business. They come directly out of quarterly earnings. By reclassifying operating expenses as capital expenses, Sullivan made costs disappear. The quarterly earnings looked healthy. The revenue growth looked strong. But it was all fiction. The scheme spread through the entire accounting department. Accountants were told to do it. If they refused, they were fired. If they asked questions, they were terminated. A culture of fear took over. One accountant named Cynthia Cooper was the internal auditor at WorldCom. She began noticing the reclassifications. She began questioning the entries, and she began digging deeper. What she found horrified her. Over $3.8 billion in fraudulent accounting entries, hidden expenses, inflated revenue, completely fabricated numbers. The entire company's financial health was a lie. Cooper went to the board of directors. She presented her findings, she explained the fraud in detail, and she demanded action. The board faced a choice: cover it up and protect the executives, or expose it and destroy the company. They chose exposure. In June 2002, WorldCom announced a restatement of its financial statements. The fraud was real. The numbers had been manipulated. And the company was in far worse financial condition than anyone knew. The markets reacted instantly. WorldCom's stock price collapsed overnight. Within days, the company filed for bankruptcy, the largest bankruptcy in American history at that time. $103 billion in assets wiped out overnight. Bernie Ebbers was arrested. Scott Sullivan was arrested. Other executives were arrested. The FBI launched a full criminal investigation, and what they found was staggering. The fraud had been going on for years. Over $11 billion in total accounting manipulations. $11 billion. Hidden inside spreadsheets and accounting entries that auditors somehow missed, or chose not to see. But here is where the story gets personal. While WorldCom was collapsing, while employees were losing their jobs, while investors were losing their life savings, Bernie Ebbers was borrowing money from the company. Not a little money, $400 million. The company's board of directors had approved personal loans to Ebbers to cover his personal losses in the stock market. He used company money to prop up his personal finances, while the company itself was drowning in fraud. Employees who had invested their pension funds in WorldCom stock watched their retirement savings disappear overnight. People who had worked their entire careers at WorldCom, who had trusted the company with their futures, lost everything. And Bernie Ebbers sat in his mansion, protected by company loans he never intended to repay. The trial of Bernie Ebbers was one of the most watched corporate fraud cases in American history. His defense was simple. He did not know. He was a visionary, a deal maker, a big picture thinker. He left the accounting to Sullivan and his team. He trusted them to handle the numbers. He had no idea they were committing fraud. The jury did not believe him. In March 2005, Bernie Ebbers was found guilty of fraud, conspiracy, and filing false documents with regulators. He was sentenced to 25 years in federal prison, the longest sentence ever handed down for corporate fraud at that time. Scott Sullivan pleaded guilty and cooperated with prosecutors. He received a 5-year sentence. The fallout from WorldCom did not stop with the executives. The company's auditor was Arthur Andersen, the same firm that had signed off on Enron's books. Arthur Andersen had audited WorldCom's financial statements for years and missed $11 billion in fraud, or chose to miss it. Either way, it was the final nail in Arthur Andersen's coffin. The firm that had survived for 89 years was destroyed within months of the WorldCom scandal breaking. Gone. Forever. One of the most respected accounting firms in the world. Wiped off the map. Because they failed the most basic test of their profession, telling the truth about what the numbers actually said. WorldCom eventually emerged from bankruptcy under a new name, MCI. The company was restructured, sold off, eventually absorbed by Verizon in 2006. Bernie Ebbers served 6 years of his 25-year sentence before being released in 2020 due to failing health. He died 2 months after his release. Scott Sullivan rebuilt his life after prison. The 17,000 employees who lost their jobs, the investors who lost billions, the pension holders who lost their retirements. They never fully recovered. WorldCom is a story about what happens when one man's ego becomes more important than the truth, when growth at any cost becomes the only measure of success, when accountants are turned into accessories to fraud, and when the people who blow the whistle are the only ones brave enough to do the right thing. Cynthia Cooper did not have to speak up. She could have stayed quiet, kept her job, protected herself. Instead, she walked into the boardroom with $11 billion worth of evidence and brought the whole thing down. She is the hero of this story. In a world full of Ebbers and Sullivans, it only takes one Cynthia Cooper. This is Boardroom Fallout, where billion-dollar lies come to light. Next up, Tyco International, the company where executives treated the entire corporation like their personal piggy bank. Private jets, lavish parties, a $6,000 shower curtain, paid for by shareholders who had no idea. Subscribe now so you don't miss it.